Today we're looking at the Vanguard Australian Shares Index ETF, VAS, listed on the Australian Stock Exchange. We'll go over the ETF fact sheet, including the management fee, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. VAS is an ETF provided by Vanguard, who own and operate the fund. Vanguard are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Vanguard, who continually issue new units in an open-end fund and not the individual company shares inside the ETF. VAS tracks the ASX300 index before fees, expenses and tax. It provides low-cost, diversified exposure to the largest 300 Australian companies and property trusts listed on the Australian stock market. It offers long-term capital growth, along with dividend income and franking credits. It pays distributions, which are dividends from the ETF, 4 times a year, with a yield of 3.66%, which would equate to $3,660 of dividend income for every $100,000 invested. It has a management expense ratio of 0.07% per year, so for every $100,000 invested, it will cost $70 per year, and this fee is automatically subtracted from the ETF unit price, so you won't actually see any fee transactions being taken from your brokerage account. Since VAS tracks the Australian markets, it is heavily tilted towards banks and mining companies. The largest portion of the fund, at 30%, is in financials, followed by materials at 22% and healthcare at 10%. Utilities, technology and communication service companies make up the smallest percentage of the fund, under 4% each. The benefit of investing in Australian shares is their historically high dividend yields due to the banking and material sectors, along with franking credits to eliminate double taxation on company earnings paid out via dividends, with the possibility of getting a tax refund if your tax rate is lower than the corporate tax rate. The bulk of the Australian stock market returns have come from dividend reinvestment, leading to the compounding growth over time. Since inception, VAS has had an average annualised return of 9.24%, which includes both capital growth and distributions or dividends. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative returns become much higher. Reinvesting these dividends creates the larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the sort of approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.